This video relates to the newspaper article titled Death Tax. And in that article, Sandy, a retiree, passed away at age 67 and because of that had to pay a lot of tax when her RIF was collapsed. And Lori didn't think that was fair. Lori, her daughter. You know, her mom had worked hard all her life, saved all this money, and now was forced to pay all the tax. So a financial planner was interviewed, and in that interview he gave two suggestions. One, Sandy could purchase a life insurance policy to help pay for that tax, or Sandy could have withdrawn some money from her RIF over time to reduce the amount of tax owing. So let's take a look and see which one of those solutions may have been the best solution. So the first thing I've done is I've estimated what Sandy probably was doing. So she had a RIF, was withdrawing money in retirement, and eventually came close to depleting the full RIF. And if we look at her estate, we can see that Lori would have received about $19,000, and in tax, probably about $3,000 would have gone to the government. Okay, but that's not what happened. Sandy passed away at age 67. We can see that Lori would have received about $77,000, but the government, through taxes, collected about $90,000, and that's what Lori didn't think was fair. So the financial planner gave two suggestions. One of them was to purchase life insurance. So if we purchase life insurance, what we can see is Lori would have received about $140,000, and the government about $82,000. Not a lot less, but it is less, and the reason it's less is because Sandy had to withdraw extra money to pay insurance premiums. So Sandy just didn't have as much money at age 67. But what happens if we had carried that strategy on through to age 90? Well, we can see that Lori would have received about $47,000, $50,000 from the estate, and that's the full value of the life insurance policy. Keep in mind, at 2.5% inflation, that insurance policy, the $100,000, has eroded from $100,000 to about $50,000. And the other thing we want to take a look at is this. If we project Sandy out to age 90, what we can see is she's actually run out of money here. And at age 85, 86, she only has CPP and OAS. So I'm not sure that the life insurance strategy long-term is the best one for Sandy. Now, the other solution was, while Sandy was living, to just withdraw a little bit of extra money from the RIF. And I suggest we'll take that money, put it into a tax-free savings account. And what do we see? Well, there's a little bit of a difference. Okay, but what if we stretch that strategy out to age 90? How does the strategy look then? And when we do that, what we see is Lori is now receiving about $31,000, and the government's only going to get $9,000, which is a fair bit better than the original plan that Sandy was following. So a lot of numbers, a little confusing, so I've tried to summarize it here on this page for you, but essentially what's happening is the life insurance strategy is the best strategy short term, and the long-term strategy, the best one to follow, would be to withdraw money from the RIF and purchase a tax-free savings account each year. Now, of course, your situation will be different. It depends on your tax rate. And the other thing, it depends on how Sandy likes to live her life. What are the things that she likes to do? What does she enjoy? Because that will also impact which strategy is going to be the best one to choose. But my suggestion is, before you just go ahead with any strategy, let's map it out and see which one actually is the best one for you.